What's going on, everybody? Welcome to another episode of The Remote Real Estate Investor. I'm Michael Album, and today with me I have a very special returning guest, Whitney Elkins-Hutten with Ash Wealth. And she's going to be talking to us today about passive investing and what we should be aware of before we get involved. So let's get into it. Whitney, thank you so much for coming back on the podcast and hanging out with me again today. I really appreciate you taking the time.
Absolutely. Thank you so much for having me back. I'm looking forward to our conversation today.
No, me too. So today we're going to be talking about passive investments, which is something that you've got a lot of experience in. And so I'm just curious to know from your experience, what do you recommend people do? I mean, how do people get involved in passive investments? Because we hear about it, but maybe I don't really know how to do it. So what are some concrete steps people can take?
Yeah, well, let's back up a little bit and actually kind of define what a passive investment is. And, really what a passive investment is, it's group investing. It seems, especially with any financial situation or, getting into the financial education world, there's a lot of terms that tend to confound and confuse people. But really at the end of the day,
yes,
syndication, passive investing, this is all group investing. How can you pull people's monies together, their talent, their expertise, their networks in order to take down a larger asset? That's
okay.
It, simply it. And so when we talk about passive investing, and let's just pick an area like multifamily passive investing, it can be self-storage, mobile home parks, Bitcoin, crypto mining, ATMs. But if we're sticking to real estate backed assets, typically what you're going to have is a structure of general partner and limited partners.
Okay.
And so in this arrangement, the general partners are the active investors, and the limited partners are bringing the down payment to the asset. Okay, so the general partners, they've got all the knowledge, expertise, the market resources. They've put together the team of the brokers, the lenders, the agents, everything that's needed to acquire the deal, run the deal, rehab the deal even. And then they're also able to bring to the table credit and lending as well as other investors' money. So the limited partner can participate in the rewards of the asset simply by contributing capital. So that was a lot, but really it's pretty simple, right? It's like, hey, Michael, you want to go buy an apartment building together?
Yeah.
Yeah, great. Let's go do it with 500 other people.
Makes total sense. And so that's where the terms GP and LP come from, is that general partner and limited partner, right?
Yeah, the general partner is the active role in the investment. I mean, think about it. You don't want 500 investors, taking on day-to-day duties of the asset, or even voting on day-to-day operations of the asset. It would that's herding cats.
Yeah.
So when an investor goes into a general partnership, into a syndication, they're looking for the opportunity to relinquish some of that day-to-day operational control in exchange for taking advantage of all this massive leverage and getting their time back. I can tell you for me, we talked last time how I built up a portfolio of over 30 single family homes and was doing flipping on the side.
Right.
That was a lot of time. I was making a lot of moving decisions. I can tell you now, I have 38 passive investments. I spend maybe an hour a month reading through the reports and, making sure that the distributions hit my bank account. I spend far more time on my single family assets than I do.
Much more active.
Yes.
Okay.
But it's leverage. What you're trying to do is create leverage in order to get that return.
Okay.
But the steps we're flip-flopping the steps. Right? Because if somebody's, if a listener here is like, man, I would love to get into passive investing, but I don't know how. I have experience in real estate, so I could be considered a sophisticated investor. Maybe they can be considered even an accredited investor because they have the net worth or the income to be accredited, but they just don't know the logical steps. We have to flip their investing model on their head. Right?
Okay.
Because up until this point, they probably have been looking at the asset itself. They've been searching for single family homes that make a really good return. And is that home in a good market that they like? And who's the day-to-day operator? It's them. They're calling all the shots and making the decisions. Now, they might have property management, okay? But they're still very much in control of the asset. When we go into the syndication model, we're flipping that on its head. The investor's actually investing in an operating business. Okay, so they need to, as we were talking before we got on, they need to learn how to bet on the jockey, not the horse. So if the horse is the deal, that's fine and all. We still want to get into assets that have good returns and numbers, but we want to make sure that we have an operator that knows what they're doing, because at the end of the day, an operator that is very seasoned, has a good track record and good business sense, they're going to be able to take any deal and navigate it through the rough waters of our economic environment right now.
Okay. All right. That makes total sense. So how do you evaluate an operator? Is it similar to how you would vet a property manager? Are you getting on the phone, calling these people and saying, hey, what's your favorite kind of food? Are we going to jive? Are we a good fit? What does that look like?
Yeah. Are you a Leo? Are you a Virgo?
Right.
I love that question. No, I mean, you could insert that question, but you might get a few chuckles out of it. But
I'm sure.
Really, whenever you're learning to vet operators, you want to think of it as a sales funnel. Anybody that's been in sales, right? You're trying to cast the widest net possible. But we want to make sure that operator that you're talking to is actually already somewhat aligned with your goals. So there's actually a couple steps that we need to take before then. One is you sitting down and understanding what your investing goals are. First, do you believe that real estate is actually a viable asset to invest in? If you can't say yes to that question,
kind of a non-starter.
Yeah, well, I mean, not necessarily, right? Like like I said, there's other assets like, crypto mining and solar and all that. They're also passive investments. But, for our conversation, we're talking real estate. Do you believe in the fundamentals of real estate? If you can check that box, move on. Okay, what do you need? Do you need cash flow? Do you need, the appreciative gains of the asset? Now, it doesn't have to be an either or. There are investments that offer both, but you need to get super clear with what you actually need, not what you want. And I run into the struggle, investors that have the struggle all the time is they're like, oh, I don't need the cash flow right now. That's fine. I just want the gains. Well, the gains are kind of like the icing on the cake. The cash flow tells me that the investment is profitable right now. Even if you don't need the cash flow, put it in your bank account, save up for your next investment, okay? Also, when you decide that, flip that switch and start living off that cash flow, it's there, okay? You're not having to wait for these investments to cycle out. So I really like encouraging investors to look at balanced cash flow and gains type strategies. Okay. Then we also want to understand what your risk tolerance is, okay? There's just like with single family homes or small multis, you can get into a development ground up deal, or you can invest in a Class A suburban, structure that, or apartment building or a complex that is, affordable housing, but is very, recently built, no deferred maintenance, and you're just kind of clipping a distribution for 5 or 7 years. So there's a continuum there. We need to understand which side of the continuum you're on. Once you know those pieces, now is the time to go find the operator.
Okay. And am I just hopping on Google and typing in syndication operator? Is it that simple?
You can. Yeah. I mean, a lot of the operators right now are online, and so they have an incredible web presence. That is one way to start sourcing operators. I also encourage investors to talk to each other, get into a group where, because, like-minded investors actually gather in places. There's websites like Crowdfunding DD, Left Field Investors, and they're sharing their investing knowledge and who they know, love, and trust. That's a great way,
awesome.
To kind of create a list. You can attend conferences as well, too, that I'm going to be at. With passiveinvesting.com this year are going to be the Intelligent Investor here in a couple weeks out in LA. And then also in my own backyard, we'll be at the Best Ever conference as well.
Right on.
So that's another place where investors and operators gather.
Okay.
Yes, Google searches are fantastic. But, I encourage people, to get a little, put themselves out there if this is really a strategy they want to go after.
Totally.
But yeah, then it's a matter of, vetting all these operators. Now you're going to search them out on their website, and they're going to have some sort of like investor club that you can apply to. And generally the next step is that you can hop on the phone with them for like 15, 20, 30 minutes to get some high level questions answered about their company and also what other open deals that they might have. So take care to read through the information that they're putting out there, because that can really answer a lot of questions to see if you guys are really aligned with each other. And then you can spend that precious time on the phone getting into some of the deeper questions that you couldn't find answers to.
Okay.
And when you're talking on the phone, you're wanting to evaluate them. Like, are they genuine? Are they transparent? Do you like them? What is their background and experience? How many deals have they done? Have they taken them full cycle? Are they doing this full time? Are they part-time operators? Some of these things throw off a red flag for me. I want somebody to take care of my money as if it's my money, not theirs. And so I want them working on that asset full time, not just part-time.
Okay.
Are there more than one operator? Okay. Are they a one horse show?
Yeah.
There's power in numbers. There's just no way one operator can certainly run the entire deal. So I like to look for 2, 3 partners or more that are operating these assets.
Okay. I was just going to ask, is it reasonable to actually get the actual operators on the phone, or is it going to be someone on their sales team that's going to tell you everything you want to hear? And then, so-and-so is so busy running these multi-billion-dollar assets, they can't hop on a 15-minute call with me. So
it depends on the size of the investment group. So typically, like if, a larger investor group, think about it, some of these deals, say it's a $60 or $80 million deal, there's going to be 300 to 400 investors individually going into that deal. So it's really,
right.
And every time a deal opens, investors have specific questions. So it's pretty, just to get everybody like on the same page, we're going to try to use a lot of manpower initially to get, investors' questions, answered. Now, it's a yes and. Okay. So initially, if the group's small, you're probably going to be talking to the direct operator, but that might give you an indication of the size of the company. As they grow, they're going to add on an investor relations team because they have more deals running, they have more questions coming in, and they want to have an element of scale to the business. Okay. Personally, I want my operator working on the deal, not necessarily talking to hundreds of investors every day. I want them focused on how they can make me money. Okay. So I don't see that as a detriment. Now,
you see that as a pro. Yeah.
I see that very much as a pro, very much as a pro.
Okay.
Now, if say I'm going to throw down, a $500,000 check or $1 million check. Yeah, I would love to talk to the operator. I would love to talk to the operator. So there's a balance here. And so you can ask to talk to the operator. There might, depending on the group, there might be some, guidelines on, what stage in, the process of getting into a deal that it's, beneficial for everybody to get on the phone. But yeah, if you're going to be investing, any substantial amount of money, absolutely, you should be able to get on the line with the operator. It just might not be until you actually identify the deal that you want to go into. So everybody's going to have different rules on that.
Okay. All right. Got it. Well, that might undo years of therapy from my middle child syndrome, always being forgotten about, never getting anyone to talk to me, but I'll work through it. I've got a great therapist. All right. Well, that's really good to know.
Oh my gosh.
That's good to know and set expectations.
Yeah. Some of the big guys that, are doing billions and billions of dollars a year of investments, you're probably not going to get the CEO of the company on the phone unless you're writing a pretty large check. If you're just writing, and I shouldn't say just, right? It's scary to write that first $50,000 check to get into a deal. Or even 20 or 25, like if it's with a smaller organization, but really it's a matter of size and scale in the organization where everybody is in their either their investing journey or in the scaling journey of the company.
Okay. All right. And
Yeah.
I'm going to put you on the spot a little bit. We're recording this early Jan of 2022. I'm curious, Whitney, to know from what you've seen thus far, specifically talking about multifamily, let's talk numbers. Let's talk minimum requirements. Let's talk what projection cash on cash returns are. And let's talk equity multiples and what's, again, being projected in the multifamily space early Jan 2022.
Well, the group that I'm with, passiveinvesting.com, we specialize in the Class A suburban asset. So really those numbers are going to vary by the business plan of the asset.
Totally.
So for us, we're really looking for that stabilized asset. And we're not talking about Class A luxury or Class A urban infill. We're talking about affordable Class A.
Okay.
Rents are still about $1,500 a month. We're not talking about $3,000, $4,000 a month rents. Gated communities, nothing like that.
Okay.
So this is very urban, suburban, housing situations. Now, the returns on this, and this is going to vary group to group. Right now, what I'm seeing across majority of operators is about a 7% preferred return. Now, guys, I hate to say that preferred return doesn't actually mean return. It just says the first 7% of the profits go to the limited partner investor. So the first year of the hold, it might be 5%, and then it works its way up to 8%, right? But the first 7% of the profits will go to the limited partner investor.
Okay.
IRR on that, probably going to be somewhere between 12 to 16%. Again, deal dependent, depends on the market you're going in, the size of the asset. Equity multiples, probably hovering somewhere between 1.5 to 1.75 on that type of asset. However, in some markets, we can actually, because rents are now taking off, we can expect I shouldn't say expect, that's a loaded word.
Dangerous word. We can hopefully expect.
Yeah, hopefully expect. But I don't think it's unrealistic to see, equity. So there's what's on the pro forma, and then there's what's being delivered. I know operators that are conservatively underwriting 2x multiples on Class A suburban assets. But again, that's more of a product of or an outcome of the market that you're in, because you can't expect that in every single market. We're not seeing that, 5 to 10% rent growth or higher in every market.
Right. Okay. And for anyone that's brand new to passive investing, they might, I'm realizing, be totally unfamiliar with the term equity multiple or maybe even IRR. So if we take just one step back, can you give us a high level definition of what that is and maybe what that means in dollars and cents?
Yeah, definitely. Okay, so let's start with the equity multiple, because this is the one that I, especially if you're new to passive investing, it's pretty easy to get your head around. So if I invest $100,000 in a deal and the equity multiple is 2x, that means at the end of the hold period, I'm projected to take my $100,000 and double it to $200,000 between the distributions of the cash flow on a monthly or quarterly basis and the capital gain event at the end of the sale. So I might get distributed $40,000 over the course of 5 years in a cash flow distribution. And then I might get a lump sum check at the capital gain or at the sale of the asset for $60,000. Okay. So I've taken my 100K, it's grown now to 200K. I can take that and now go invest that into the next deal. That is the power of the scale of this. And I didn't have to do anything.
Right.
But do the initial due diligence and just, maybe answer a survey at the sale of the asset of whether I want to, consume that, take it all back into my possession or roll it into a 1031 exchange.
So you have the ability to 1031 with passive investments as well.
You do within the same LLC structure. So it's not like you get to say, okay, great. My asset with operator A is selling. I'm going to 1031 into operator B or even into deal B with operator A. You're not able to do that. What you are able to do is the collective entity that invested in that initial asset stays together and purchases another asset.
Okay.
They essentially, or they move into what they call a tenant in common relationship into another asset.
Okay.
So they can either take down fully another asset themselves, or they're going to stay collectively and go partner on another deal.
Okay.
But that's kind of hard. I mean, I look for operators that have every indication that they want to do that, because it's such a powerful multi-generational wealth building strategy.
Yeah.
But it's certainly not a guarantee. I mean, it's difficult to do that. The timing, the regulation behind it. It's a little element of herding cats with the investors at the end to get them to like make a decision. But that's also where, we talked about that investor intro call. The operator's trying to get a sense of the investor if they are a good fit for the deal as well. And the investing goals are aligned.
Okay. So it's a little bit like everyone's evaluating everyone. Better be on your best behavior.
To a certain extent, yeah.
And then can you talk a little bit about IRR? And so how investors should be thinking about that when they see a number thrown at them?
Yeah, it's a calculus term. So it's funny. I do weekly webinars to help kind of demystify these terms and the whole process, and move people through the 7 steps. And one of the things that people ask me about quite often are the IRR. Like, what does that really mean? And really what the IRR allows us to do is what is the return when we take into account when we get our capital back? So the example I like using is, Michael, how likely are you to invest in a deal if I said the return is 20%?
I would be interested, cautiously optimistic.
Oh, what's the natural next question?
Is 20% over how long a time period?
Aha! How long of a time period? When do I get my capital back? If I say, well, hold on, I gave you the answer to the next question. Okay, I say, it's 20% over 10 years.
Okay, and yeah, when do I get my investment back?
When do I get my investment back? That's what the IRR allows us to, help calculate. So because maybe I say you get 20% over the first 10 years, but you don't exit the first 10 years and you don't exit until year 20. You're kind of like, whoa, hold on. Like, what happened here? The IRR just takes into account, it's usually a little bit lower, like a 2 or 3, especially when we're talking 5 to 7 year holds. It's going to be a couple of percentage points lower than the ARR, the average annual return. But it actually takes into account when I get my money back. So the IRR for shorter deals tends to be higher because you're getting your money back quicker. The IRR drops the longer that you hold the asset because it's taking longer for you to get your initial capital back. It is somewhat of a good number to use to compare deal to deal. So if you're looking at 2 deals that have both a 5-year hold, what is your potential IRR? Now, there are people out there that are going to just say, hey, why are we even looking at IRR? Because the pro forma is an educated best guess onto the business plan of the asset. So, it's one data point to look at. You need to look at all the other data points. And one thing to look at within the investment summary is to see if the operator puts in what we call a sensitivity analysis. So in the sensitivity analysis, they're not going to just give you one IRR. They're going to give you a range of IRRs that could possibly happen within that whole period, and based on the net operating income that's going to be generated on the asset and how cap rates move. Okay, so if they're projecting they're going to make, let's just throw out a number, like $10 million profit on the asset, and the sensitivity analysis would calculate, and let's say the going in cap rate was 4%. Okay, the sensitivity analysis should probably run what happens if cap rates at the exit is 3.5% and all the way floating up to say 4.5 or 5%. Now, when cap rates go down, we're all like doing high fives with each other because it all means we made more money. Okay.
Right.
Okay. So 10 million divided by 3%. Okay. That's essentially, I don't have the calculator in front of me, but that's how much you would make on the gain.
Right.
Versus the other way, if cap rates float up to say 4.5 or 5%, you're dividing by a larger number, so you're not going to make as much.
Right.
But you're still making money because you're producing value on that asset.
Okay. All right. And another question for you is, I know that there's multiple ways that you can earn money or make money in a passive investment. And there's some terms that I think are out there that anyone who's probably reading an OM or offering memorandum may have come across. So can you talk to us about hurdles and waterfalls and what a preferred return is versus any other kind of return that's available in some of these investments?
Yeah, absolutely. Okay, so preferred return, we touched on that a little bit. The preferred return is not a guarantee. Think about it. If I'm the general partner and Michael, you're the limited partner, okay? I'm just saying, Michael, I'm going to give you I believe so much in this deal. I'm going to give you a preferred return of 7%, meaning I'm going to give you the first 7% in the cut in profits on that deal, whether they come from cash flow or equity. But you and I are partners, okay? So that 7% preferred return is not an expense on the deal. And I think this is where, new limited partners get a little confused. They were like, where is my distribution? Where's the line item saying that I get 7%? Okay. You're not debt on the deal.
Right.
Okay. We're splitting equity. Okay. Very different. Okay. Now we were talking about some higher level, I don't want to call it limited partner investing, like 201, because these are concepts you really should understand before you go into your first investment. But I will, say that sometimes they're hard for people to get their head around. But when we talk about the waterfall, we're just saying, okay, who gets paid what and when? That's simply what we're doing. Okay. And now think about it in terms of like your own house. Okay. What is the first bill that you're going to pay every month on your house? If you have especially if you bought it with a loan, what are you going to pay?
Mortgage.
The debt. You're going to pay the debt on the property, right? Because otherwise the lender is going to foreclose on you.
Right.
Okay. So the lender sits first in what we call the capital stack. They get paid first. They're number one, they're top dog in the waterfall. Then we've got, any sort of secondary debt on the property. If there's a second loan or a mezzanine loan, okay. Then right behind that, if there's a preferred equity investor,
okay,
somebody that wrote a super large check, like $1 million, $5 million, $10 million, they have the power to probably negotiate some better terms within the deal. Okay, so we've got our debt. Now we've got our preferred equity investor. Okay. And not only can they get better terms, but they're probably negotiating a higher position in the capital stack.
Okay.
Behind that, now we're talking about, okay, we've got our limited partner class, and then we've got our general partner class. Okay. Now, I'm not going to give them A's and B's because it'll confuse people because, PPMs, the legal documentation has all different letters to them. Let's just call them the LPGP. The LP, the next part of the waterfall, they're going to get their preferred return. Okay. Remember me as the GP, I said, I'm so confident in my deal that you're going to get the first 7%.
Right.
So that's the preferred return. Okay. Now, the waterfall might split out between cash flow and gain, like what happens there. But one of the structures that we love using is saying 7% preferred return and then 70-30 split on all other profits.
Okay.
70% goes to the limited partner, 30% comes to the general partner.
Okay.
Now, you threw in a term there, IRR hurdle. Okay. Now we're going to slap a criteria. We're going to split 70-30 until you reach a 15% IRR as the limited partner.
Okay.
And then we're going to change and we're going to split things 50-50.
Okay. All right.
So that's what the hurdle is. It's an incentive for me as a general partner to perform better in order to get a larger split of the deal.
Okay. That makes total sense. I mean, I think that's intuitively a smart thing to have inside of these deals. But let me ask a question for all the little people out there, the little guys, the little fish. What if someone could easily say, well, Whitney, you're very experienced and you know the numbers inside and out, and I don't really know the numbers. So you could likely sandbag these numbers and show a lesser return, knowing full well that you're going to cross that waterfall far above and away, right? So how do we evaluate the reality of the numbers that we're seeing, or the reasonableness of the numbers we're seeing?
That is so interesting. And I would say I understand the sentiment, and I hear it the other way. People are like, prove to me you're going to actually make this. Not so much like, how are you sandbagging? I mean, here's a perfect example. Anybody that was trying to sell a multifamily asset in April or May of last year of 2020, we didn't know what cap rates were. We didn't know the true value of the asset. We didn't know if net operating incomes on some of these assets were going to take because tenants weren't paying. So my question, I kind of throw it back to you. I don't have a crystal ball. Do you? I don't know. I'm going to mitigate my downside, right? Because think about it, as the general partner, I'm giving the first 7% to you, or a preferred return, and then I'm like giving you the lion's share of the split. And I get, the bottom barrel,
the
30%.
Leftovers. Yeah.
And there are fees along the way and stuff like that. But I think a lot of, they're not as lucrative, I think, as limited partners would like to think they are for the general partnership. I mean, think about it. There's a lot of expenses that go into acquiring a deal. I just did a webinar yesterday with my acquisitions team. And they were like, we underwrote 500 deals last year, closed on 11.
Wow.
I mean, how much manpower are you putting behind that?
That's huge.
So there's a lot that goes into this. But I want to mitigate my risk too, right? As a general partner, I don't want to, go into a deal where I don't think I'm going to make any money. And think about it this way. We haven't stopped splitting. It's not like at 15% IRR, I'm capping, the limited partner investor in that waterfall example. No, we both continue to make money.
Love it.
We're just splitting it 50-50, right?
Makes total sense. Whitney, the last question I have for you before we get out of here is, we've talked how to evaluate the jockey, the operators. We've talked how to think about the numbers. Where do people draw the line, or how should people think about where to draw a line with getting into the weeds on the numbers and evaluating and kind of looking to get an understanding of what all the different numbers mean versus saying, hey, I've evaluated the operator, I'm good. Let's do the thing.
Awesome. Well, there's a few other steps in here we didn't get to cover. And I just want to invite everybody, if I may, to a website, because we won't be able to get into all the steps. But I actually have a download there at passiveinvestingwithwhitney.com. And you can go there and sign up and get this free download. It goes through all 7 steps of what you tangibly need to do, tactically need to do to get into your first or next investment.
Awesome.
I'll also have a ebook that will walk you through in greater detail. It expands on this cheat sheet that I have available for everybody. The operator's one piece. You can control your goals. You can control the operator that you invest with. You can control the strategy you go into. You can also control, as a limited partner, the market you invest in and the deal that you can go into. You should evaluate the market and the numbers. I'll give you some questions in that ebook that you can, run through and, kind of double check things for yourself. There'll also be a checklist of how to underwrite a deal. Actually, I'll give you the link to the webinar that I did last week. That will walk people through, step 1, 2, 3, 4, 5 of how to underwrite a deal from the limited partner perspective. Okay, it's different.
Perfect.
Than if you've ever purchased a single family house before. So like the numbers, we didn't have to talk about IRR before. Probably you were just looking at cash on cash or
right.
Equity growth.
Right. Oh.
Then what do you need to do to vet all the legal documentation? that would be like one of the, step 4, 5, and 6. So,
okay. All right. Well, yeah, we will definitely link to that in the show notes. Thanks so much for sharing.
Yeah.
And for people that didn't catch the last episode, how can people learn more about you, reach out to you, get in touch with you?
Yeah. If you're interested in passive investing, reach out to me at passiveinvestingwithwhitney.com. And if you're interested in building your own personal single family rental portfolio, you can also, reach out to me at ashwealth.com.
Awesome. Whitney, this was yet again another fantastic episode. Thank you again for hanging out with me. And I'm sure we'll be chatting again soon because you're a wealth of knowledge.
Awesome. Thank you so much. And I'm so thankful to, share all this powerful investment strategy with your listeners.
Awesome. Love it. Talk to you soon. Alrighty, everyone. That was our episode. A big, big, big thank you to Whitney. She is so much fun to have on. Just a wealth of knowledge. I got a ton of my personal questions answered because some of these episodes are very self-serving. So as always, if you like the episode, feel free to leave us a rating or review wherever it is in your podcast. We look forward to seeing you on the next one. Happy investing.